All right, let's talk about it. You pay your health insurance premiums every single month. You do your part, right? You trust that when you get sick, when you really need them, they're going to be in your corner. I mean, that's the deal. It's the whole point. But what happens when that promise gets shattered? When instead of help, you get this? That sound, that one word, denied. This isn't just a frustrating piece of paper. For millions of people, this is the start of a crazy, exhausting, and often financially devastating journey into a system that feels like it was designed to do exactly this. And we're going to pull that system apart, piece by piece, in this explainer. Because what looks like a simple rejection, what feels like a mistake, is actually the last, very calculated move in a playbook that's been perfected for decades. So, the first thing you have to get your head around is that these denials, they're not being handed down by some person in an office carefully looking over your case. Nope, they're happening at a totally inhuman scale with inhuman speed. That mountain of paper you see, it's all being spit out by these silent, glowing server racks. This is the modern denial machine, and it operates on a level that's just, honestly, it's hard to even wrap your mind around. Get this, 1.2 seconds. According to a major class action lawsuit, that's the average time Cigna's doctors spent reviewing a claim before denying it, all using their algorithm, a system they called PXDX. The suit alleges that in just 2 months, this system rejected over 300,000 claims. Just let that sink in. A doctor's review, a process that should involve careful thought about a patient's health, was boiled down to less time than it takes to tie your shoes. That is not enough time to even open the file, let alone do a doctor's duty. This is automation for the sake of rejection, not care. And the result of all that speed, a massive explosion in denials, especially for the people who are the most vulnerable. A Senate investigation found that after United Healthcare brought in its own algorithms, its denial rate for what's called post-acute care, that critical hands-on care you need after a hospital stay like physical therapy or rehab, it more than doubled in just 2 years. So why go after these patients? Well, it's simple. They're exhausted, they're recovering, and their care is expensive. The algorithm is basically programmed to find the biggest bills and just build a wall, right when people are at their absolute weak. So here's the kicker. These lightning-fast denials, they're not just fast, they are often completely, totally wrong. This quote is from a lawsuit against United Healthcare's AI, and it is just staggering. It says that a full 90% of the company's algorithm-based denials were overturned when somebody actually appealed them. 90%. That's not a system with a tiny glitch. That's a system that's fundamentally broken. It's like casting a giant net designed to just say no to almost everybody, knowing full well most of those no's are for care that's actually necessary. And this slide right here shows the cold, hard math that makes this whole thing so profitable. Why on earth would an insurance company use a system that's wrong 90% of the time? Because they know this number. Less than 1%. Even with those insane error rates, fewer than 1 out of every 100 patients ever files a formal appeal. The appeals process is a nightmare by design. It's a maze of paperwork, endless phone calls, impossible deadlines, all while you're just trying to get better. It's made to wear you out. So what happens? People just give up. They pay what they can't afford, they go into debt, or even worse, they skip the care they need. The insurer is just playing the odds, and the odds are stacked way in their favor. So how did we get here? How did a system that's supposed to be about health turn into a system that seems to profit from sickness? Well, it was no accident. It's a playbook, and it's been fine-tuned over decades. And in this explainer, we're going to peel back all the layers. First, we're going to look at the original strategy, which was actually born in a totally different part of the insurance world. Then, we'll uncover the secret money-making engine that powers the whole thing. And finally, we'll show you the regulatory shell game that lets it all happen right out in the open. Okay, so let's start at the very beginning with what you could call the playbook's original sin. To really understand the tactics they use against you today, we've got to go back to the 1990s, because this whole aggressive denial strategy, it wasn't invented for your health insurance. No, it was perfected in the world of car accidents and property claims. So back in the mid-90s, big property insurers like Allstate hired the legendary consulting firm McKinsey with one simple goal: redesign their claims process to make more money. And in 1995, Allstate launched the result, something called the Claims Core Process Redesign. Now, this wasn't just a small change, it was a total shift in philosophy. It reframed paying a legitimate claim not as keeping a promise, but as a loss, a hit to the bottom line. And it worked so well that by the 2000s, the health insurance industry was paying very close attention. And at the heart of McKinsey's whole strategy was this really powerful metaphor designed to flip Allstate's famous slogan on its head. The idea was to split people making claims into two groups. For the ones who would take a quick, lowball offer, often before they even knew how badly they were hurt, you offer the good hands. But if someone refused that low offer and decided to fight for what they were actually owed, you hit them with the boxing gloves. You dig in for a long, drawn-out, and expensive fight designed to just crush their will to keep going. And this boxing glove strategy was built on three main tactics, a trifecta that got a pretty infamous name, the 3Ds. First, deny. Just reject the claim, often for a weak or bogus reason, and force the other person to start the fight. Second, delay. This is where the psychological warfare comes in. Drag everything out, lose their paperwork, demand more and more documents. The goal is to create crippling financial and emotional stress, making them burn through their savings while they wait. And third, defend. If they still haven't given up, you unleash your army of lawyers and make it so expensive to fight for your claim that it's just not worth it anymore. I mean, how deep did this philosophy go? Internal McKinsey training slides that later came out in court used this exact image, an alligator, with the instruction to sit and wait. And this wasn't just a cute metaphor, it was a core strategy. See, the alligator doesn't have to chase its prey. It just has to wait, because it knows that time is its single greatest weapon. Every single day that goes by, the person with the claim gets a little more desperate. Their bills are piling up, and their resolve starts to crack. Delay just makes it way more likely they'll take pennies on the dollar out of pure desperation. Okay, but that raises a really important question. I mean, denying a claim, that obviously saves the company money. And defending a claim, well, that sends a message. But what about just delaying? Why is simply making you wait such a powerful and profitable move? What's the hidden financial upside to just holding on to your money? The answer to that question reveals the real economic engine of the entire insurance industry. And that brings us to the second pillar of this whole playbook, the secret of insurance floats. This is a concept that's often misunderstood, but it is a massively powerful economic idea that turns the delay tactic from a simple stalling game into an actual profit-making machine. So what is float? Well, to put it simply, it's all the premium money that you and millions of other people pay in. The insurance company gets to hold on to this gigantic pool of cash until it eventually has to pay out claims. But in between, which could be months, even years, they don't just let that money sit there. They invest it. Stocks, bonds, you name it. The float is basically a giant interest-free loan from you, the customer, that the insurer uses to act like a massive investment firm. They are literally making money with your money before they even pay for the care you already paid for. And hey, don't just take my word for it. Nobody understands this better than Warren Buffett. His entire empire at Berkshire Hathaway is basically built on the genius of insurance. He flat out calls float free money and says they get paid for holding it. I mean, that perfectly captures the mindset. The business isn't just about paying claims, it's about getting as much of this free money, this float, as possible, and holding onto it for as long as possible to invest it. And the delay tactic is the #1 way to do just that. Let's try to visualize this. Imagine all of our premiums are a river, flowing into this huge reservoir. That reservoir, that's the insurer's float. Now, the company's job is to build a dam to hold back as much of that water as they can, for as long as they can. Why? Because that dam has a turbine on it, and that turbine is powering an investment factory that just prints money. Every single day they delay paying a claim, every day they keep that water level high, the more profit their factory churns out. The claims they eventually pay out are just a tiny, controlled trickle of water let through the dam. The real money is made from the reservoir itself. Now, to be fair, the importance of float is different for different kinds of insurance. For something like life or property insurance, where claims can take years and years to pay out, the investment income from float is where they make almost all of their profit. For health insurance, it's a smaller piece of the pie, about 20%, because claims get paid faster. But don't let that number fool you. 20% of a multi-billion-dollar industry is still a massive amount of money, and it creates this huge built-in incentive to delay every single payment for as long as legally possible. And here's the connection that most people never make. The insurer's float isn't just some abstract financial term. It has a real-world name. It's your doctor's and your hospital's accounts receivable. The money that the insurer is holding on to and investing, it's the very same money that hospitals are waiting for to get paid for the care they already gave you. It's a direct transfer of financial stress. The insurer's asset is the provider's debt. And that pressure on hospitals, it has real consequences, like understaffing, old equipment, and higher costs for all of us. And this is not a new problem. For decades, the average time it takes a hospital to get paid after they bill an insurer has been stuck at right around 47 days. Since 1998, that number has barely moved. I mean, think about all the technology that's changed in that time. We've gone from dial-up internet to instant money transfers, yet the speed of insurance payments to hospitals is just frozen in time. This is proof that the delay isn't a bug. It's an intentional core feature of the entire business model. So at this point, you're probably thinking, okay, this is outrageous. There have to be rules to stop this, right? Some kind of regulations to protect us from these games? And you're right, there are. But what if I told you that even the rules that were designed to protect you have been twisted into just another tool for making a profit? A tool that actually lets them drive up the cost of healthcare for everyone and make even more money while they do it. And that brings us to our final pillar, gaming the system. And we're going to zero in on one specific rule. It was a well-intentioned consumer protection that came out of the Affordable Care Act, but it's been so cleverly exploited that some people have actually called it the perfect crime. The rule is called the Medical Loss Ratio, or MLR. And on paper, it's a simple, really powerful idea. It basically says that insurance companies have to spend at least 80 to 85 cents of every dollar you pay in premiums on actual medical care. The other 15 to 20 cents, that's for their admin costs, marketing, and profit. And if an insurer gets too greedy and their profit margin goes over that cap, they have to pay you back the difference in a rebate. It's supposed to make sure you get value for your money and keep insurer profits in check. But this formula created this really bizarre backward incentive. Think about it. Since an insurer's profit is capped as a percentage, say 15%, the only way to increase the actual dollar amount of their profit is to make the whole pie bigger. If your premiums are $1 billion, your 15% profit is capped at $150 million. But if you can make that pie grow to $2 billion in premiums, suddenly your 15% profit is $300 million. And how do you justify charging higher premiums? Well, you have to show that your medical spending is also going up. Now, that sounds like a complete paradox, doesn't it? How can an insurance company possibly make more money by spending more money on healthcare? It goes against all business logic. The rule was designed to make them more efficient. But they found a loophole so massive you could drive a multi-billion-dollar healthcare empire right through it. And that loophole is called vertical integration. Over the last decade, the big insurers like UnitedHealth, Cigna, and CVS have been on a massive shopping spree, buying up every single part of the healthcare supply chain. So UnitedHealth now owns Optum, which employs tens of thousands of doctors. CVS Health owns the insurer Aetna, but it also owns thousands of pharmacies and the powerful drug price middlemen. So now the parent company is both the buyer and the seller. This lets them run this just brilliant shell game. The Aetna insurance part of the company can pay its own CVS pharmacy part an inflated price for a drug. That huge payment gets counted as a medical expense, which helps Aetna meet its 85% spending rule. But the extra profit isn't gone, it's just been moved from one pocket to another, less regulated part of their own corporate empire. They're just paying themselves. And this shows you just how insane this can get. This is a real-world example. An independent pharmacy sells a generic chemo drug for about $72. But when CVS Health, which owns Aetna, bills Aetna for that same exact drug through its own specialty pharmacy, the price is over $17,000. That entire $17,000 counts as a medical expense for Aetna, helping them avoid paying you a rebate. Meanwhile, the massive profit is just captured by another division of the very same company. It's a perfectly legal way to launder profits and make it look like the cost of care is just skyrocketing on its own. So let's just pull all of this together. When you get that denial letter in the mail, it feels personal, right? It feels like a mistake or like your case is just really complicated. But what we've seen here is that your individual fight is actually you running headfirst into a massive, interconnected system. A system that is working exactly the way it was designed to. It's a system built on 4 pillars, and they all prop each other up. You've got algorithmic denials, which automate no on an industrial scale. You've got the old-school deny, delay, defend playbook to wear down anyone who tries to fight back. The delay part of that playbook gets supercharged by investment float, turning every stalled payment into pure profit. And finally, MLR gaming creates the incentive for the whole system to just get more and more expensive, creating more premiums to deny and delay and more float to invest. It is a perfect closed loop. So here's the bottom line. Your denied claim, it's not a series of unfortunate mistakes. It is the logical result of a very sophisticated financial machine designed with total intent. It is a machine where your medical care is labeled as a loss on a balance sheet and where the fundamental promise of insurance is in a direct, constant conflict with the real goal, maximizing shareholder value. Now, I know this can all feel incredibly overwhelming. I mean, it's you, a single patient, against this massive interlocking system. So, is there any hope? The answer is yes. There are class action lawsuits challenging these algorithms in court. There are even new AI tools being built to help patients and hospitals automate the appeals process, basically fighting fire with fire. But the real first step for any meaningful change is exactly what you're doing right now. It's understanding the playbook. Because when you understand that the denial you got is probably a business strategy, not a final medical decision, when you understand that the delays are a deliberate tactic designed to make you quit, and when you understand the shell games they're playing with the numbers, you are no longer just a victim of the system. You become an informed person who can actually start to push back. And that knowledge is your power. We spend a lot of time digging through lawsuits, reports, and financial documents to map all of this out. If this explainer armed you with some new knowledge, help us arm other people by hitting that like button and subscribing to the explainer. And we genuinely want to hear from you. Have you or someone you know ever run into one of these 4 pillars? The algorithm, the 3Ds, the endless delays, or just some absurd pricing? Share your story or just your reaction in the comments below. Because the more we all talk about this, the harder it is for the system to ignore. Thanks for watching.